my name is Dan Bossie. I'm here with Dr. Bill Tierney. We're here to talk to you about the Federal Reserve, something we don't talk a lot about in agriculture, but there's a really big meeting that's happening tomorrow. The FMOC started today, but tomorrow at around 1 o'clock Central Time, they're releasing their announcement whether or not they'll be raising interest rates. Why is this so important, and why would we bother in an agricultural forum to talk about this? Well, this is the first time in 7 years that the Fed may raise interest rates. And indeed, although it would not have much of an impact on agriculture in terms of a lending perspective, it may have an impact in terms of emerging markets and currencies. And so with that, Bill, if we raise rates tomorrow, would you think there would be any activity in the value of the ruble or the Brazilian real or anything currency-wise?
Well, I would hate to call what is the equivalent of a trading recommendation. In all likelihood, if the U.S. Federal Reserve begins to tighten money supply and U.S. interest rates rise and the rest of the world does nothing, then if you don't change anything else, if you don't change economic activity, if you don't change technologies in other countries, what you're likely to see is that the dollar will appreciate relative to the currencies of everybody else. From what I've seen, many of our trading partners and many of our agricultural competitors have economies that are in the doldrums right now. And generally, the monetary policy that's recommended when an economy is in the doldrums, like Brazil's, which is in a recession, like Russia, which is in a recession, is to keep interest rates low to stimulate economic activity. So we may see the exact opposite occur. We may see the United States tightening money supply, pushing up interest rates, and economies like Russia and Brazil, Argentina, which are suffering from recessions, actually following loose monetary policy. Same thing may be happening in Australia, same thing may be happening in Canada, same thing may be happening in Europe. So we may actually see this divergence between the value of the dollar and foreign currencies widen very sharply because they're moving in opposite directions at the same time.
Yeah, and if we look back, and I think we've included a chart within this presentation where we look at the price of the lira or the Argentinian peso, the ruble, the Brazilian real, they've fallen a lot in value already. But you bring out a very good point, Bill, which is the dollar's at a position that is individual to itself and the exact opposite to the rest of the world.
At least many of our major export competitors, as I mentioned, Canada, Australia, the European Union, Russia, Ukraine, Brazil, Argentina, all of those countries have significant economic problems. If they're not in a recession, they're trying to avoid a recession. So following the Fed with tighter monetary policy is not in the monetary playbook. It's the exact opposite. Right. So because our economy is doing so well, relatively speaking, the Fed is going to tighten, expected at some point, to tighten money supply, drive up interest rates. And so we may see, as we've talked about for quite some time, we may see an even further widening in the exchange rates, dollar versus these other currencies.
So let me step back in time just for a minute. You and I go out and do some meetings. We talk about world and U.S. and emerging market GDP rates all the time. And in fact, there's a chart we're now looking at. If we look at those GDP rates, starting in around 2002 or 2003 and looking backwards in time, it seems like we were all linked together. Then at 2003 or 4, we started to see the emerging market leading world GDP growth. I think at that point, Goldman Sachs came out with the term the BRICS, Brazil, Russia, India, and China. Now, with emerging market currencies collapsing and their consumer appetite lessening because of the high cost in their currency values of what commodities would be, we're seemingly to join again. So my question to you is, this window that we had from 2002 or 3 up until 2013, that 10-year time frame, was that an anomaly, or is that something that we should probably look at longer term?
You know, Dan, I recall very, very clearly going into the global recession of 2008-09, a lot of the macroeconomic commentary said that we've never seen a global recession since the Great Depression of the 1930s. And that the economies of the major OECD, the North American economy, the European economy, the emerging market economy, were not that closely linked. I don't know if the fact that we had the first global recession in 2008-09 is a reflection that we are linked, or whether it was a coincidence, or if it's a little bit of both. I'm certainly, I don't have the time or the skills to be a global macroeconomist. I think that most people would argue that the global economy is becoming increasingly linked. If it's so linked to the point that the U.S. cannot continue to have an economic recovery while other major countries are in a recession, I don't know if that's true or not. You'd have to talk to somebody on the Fed research staff.
I understand. I just from a commodity perspective, though, we talk about the BRICS. I wonder if we should be calling them the ICS, which is India and China, because of the Brazilians and the Russians, of course, being in recession. They no longer have that lift to the commodity markets as we've been.
No, or Brazil. They're supposed to have a recession at 2.25% this year.
Anyway, we wanted to point out to you the dichotomy that is going on in the world economy, and that we believe as we go forward, the linkages which may be occurring again, and that at least this super cycle in commodities has again been over, as confirmed by the emerging markets, and how important that'll be to commodity producers going forward. In our next video segment, we're going to talk a little bit about the difference that we are today relative to agriculture in terms of the Black Sea being a much more significant exporter, as is Latin America and soybeans, and what the currency means to the overall landscape for the U.S. and world farmer. Thanks again for joining us. My name is Dan Bossie, joined by Bill Tierney. We'll see you then.